Foster's has rejected a $2 billion private equity bid for its wine business. The group was quick to dismiss the offer, saying it significantly undervalues the Treasury Wine Estates and its growth prospects. With Foster's also considering the option of a demerger, the market is predicting bids for the whole company may start flowing. Here's Emily Stewart.
The celebratory drinks almost started, but the liquor giant isn't ready to come to the party.
It's a nice, cheeky little opening bid that has been put on the table, so I'm not surprised that Foster's has turned it down.
Foster's wasn't being social, leaving it to a statement to entertain the guests. An international private equity firm made a cash offer of between $2.3 and $2.7 billion for the company's wine division. But it's not enough. In a statement to the ASX, Foster's said the board considers the indicative proposed value range significantly undervalues Treasury Wine Estates and its future prospects. Foster's remains adamant that a demerger of its beer and wine assets will still go ahead.
There are a lot of issues to consider in corporate areas, operational areas and in people areas. We are on track to unscramble these complexities, and the evaluation of issues and costs and benefits of a potential demerger, that's all progressing well.
But analysts say the company will only bother with the demerger if a higher bid doesn't surface.
Book value of the assets are significantly higher than that opening bid. And I think they're just trying to flush out more buyers with coming out with this press release.
Foster's wine business is worth between $3.5 and $4 billion. This is despite the wine business underperforming last financial year. Assets were written down to the tune of $1.3 billion pre-tax. And the future of the industry isn't certain.
We do expect market conditions in the wine category to remain mixed, with oversupply in the Australian market, a subdued consumer environment in key overseas markets, and the strength of the Australian dollar expected to have an ongoing impact.
It's a very tough business with low barriers to entry, very low barriers to imitation, and there's a huge amount of choice. So it's a difficult business to generate sustainable competitive advantages in.
Some analysts say it's no surprise that an equity firm considers the business worthwhile.
They will use a large portion of debt to make the acquisition, so they only need very small improvements in earnings before interest and tax in order to generate very large returns on the equity that's actually invested, and that's because of the leverage they use.
But many analysts now believe the entire company could be up for grabs. With an option to sell off the wine division, a buyer could be interested in the lucrative beer business.
This bid on the wine asset is going to speed up the whole process. Anyone who wants to come in before the merger has actually gone through now knows that there is a buyer for the wine assets, so they can actually buy up the whole company now and actually get rid of the wine assets.
After the bid was rejected, shares rose as much as 5% to $6.40 and closed up 4% to $6.30. Foster's will now sit back and wait to see who else wants to join the party.